G'day, money miners. Early day for us, late day for our guest from stateside,
New York.
Oh, great. We're feeding this China story, JD. Mate, just like MMS is feeding all the dirt to provide the steel for any potential boom in China stimulus. So, mate, if you want to take advantage of any uplift in the China economy, get MMS to start moving the dirt for you. Contract ready, the gear's ready to go to take advantage of China.
All right, Matty.
Couldn't have said it better.
Well,
mate, JD, you've done a bit of recruitment hustling as per usual. We've got Shehzad Qazi from stateside. Mate, Cobber, thanks for staying up late and having a yarn to us today, mate. Welcome to Australia briefly.
Thank you. Thanks for having me on.
Matty, I'm pretty excited to share this one. We've got a bit of an itch we need to scratch in this China narrative in recent times, and I actually heard a colleague of Shehzad's, Leyland, speak on a podcast a few weeks ago, and I thought their views were so interesting and a bit different to what you're hearing out there. I thought, why not just get them on and let's chat about it on the podcast. So I think the best place to start this one, Shehzad, with all the news and all the so-called experts about China flying around in recent weeks, I want to hear from you what the biggest misconceptions that you're seeing out there with this China stimulus narrative in the recent 2 or 3 weeks are.
Well, I think the biggest one is that this was immediately treated as the Chinese policymakers are panicking. There's an economic crisis, and they are stepping in with a big bazooka stimulus move to solve the problems in the Chinese economy. But that's not all. This is a pull out the stops, do whatever it takes draggy moment for China. I think that was the biggest misconception that we saw there. And the problem, by the way, is there is no economic crisis in China, right? It's the people who think there's a crisis in China who then tell you, oh, the Communist Party is panicking, there's a crisis, and now they will throw as much money as they possibly can or need to fix the problem. And so that narrative snowballs into being something bigger and badder and way more impactful sounding than so far it seems any of it will be.
Was there misconceptions on the scale when China says they're going to do something? Do people is there a misconception about how much they have to do based on how big China is? Was that taken the wrong way?
I think there's absolutely a part of it, which is just this obsession over the overall number, the size of the package. And people are throwing around, sums in the various trillions if you want. It's going to be a 10 trillion this and a 6 trillion that and so on and so forth. But the other problem is just kind of saying it's stimulus, stimulus, stimulus without specifying what the policy approach actually is and whether what's being announced is actually going to be seen practically getting rolled out, and also what's being announced, is it addressing the challenges at hand? So let me just get very specific about that. A big chunk of what was discussed up front was actually in the area of monetary policy easing, bringing down the required reserve ratios and forcing banks to lend out more money. But the fact is, China's had a lot of monetary policy easing over the last couple of years. The problem in China isn't that the cost of capital has been very high or that it's been rising. And companies are actually reporting to China Beige Book year after year for the last few years that the overall interest rates that they have to pay on any loan that they're taking out, they're actually coming down. The problem is companies are just simply not interested in borrowing at the levels that they used to, before COVID, because they're not hiring at those levels. They're not investing at those levels because the economy is not running at that pace anymore. So you could do monetary policy easing, but that kind of stimulus is not going to work anymore because the problem is not one that can be solved by monetary policy. So that's just a big one, right, for starters, that markets have completely misunderstood and I think missed.
So how does China then break this? I think as your colleague kind of put it, it's a doom confidence loop. How do they crack that?
Well, I think a lot of what they did was exactly getting at that. They said, look, equities are falling. They're, not a week goes by when some kind of investment bank report doesn't come out doing a GDP forecast downgrade. There are fears that the sky is falling. And this is a real problem when it comes to economic commentary or market commentary on China, right? It is very bipolar. either it's boom times and everything's going great and everything's going to soar and record-breaking rallies and high growth levels, or it's a massive bust. China's in a crisis. You've got a Lehman moment upon us, and the sky is falling. And so this tends to be a real weakness in the China commentary world and China watching world, period. And I think some of it was just done to say, okay, we need to provide some kind of floor so that there's a floor within the sentiment, floor when it comes to the market participants, the investors, to a very large extent, I think, domestic confidence and so forth. So the idea is to arrest that, to make sure that you don't kind of go down that doom confidence loop. And if you announce enough moves and maneuvers to help buttress the economy, you get some of that as we've seen play out over the last few weeks now.
So were you surprised that one of the mechanisms they did that through was sort of buffeting the stock market?
No, not surprised at all. I mean, look, there has been over the last several years, we've seen a few face-ripping rallies now since, especially the lifting of COVID zero, but really even this 2022. And the rallies have all resulted in just sell-offs, one after the other. And I think we were in the middle of a pretty big sell-off after what was a pretty impressive rally at the beginning of the year, when, as you remember, again, the hope was that China was just going to take off this year. And I think a big chunk of the approach was, a significant amount of the approach was, hey, you know what? Let's create a little bit of confidence there. Let's give markets a reason to rally a little bit. And let's, more importantly, anytime there is a sell-off in China, which is severe, and you start getting into bear market territory, one of the things you get is that the national team, so to speak, steps in and starts buying up stocks, right? And what they've done this time around is make this a little bit more formal in many ways. They've created that stock market stabilization fund, which actually then relieves some of the pressure off the national team because it creates a mechanism for other institutional investors and so forth to get in there and buy. So what they're doing is they're institutionalizing a lot of that sort of approach that they already have in paper. Now, that said, let me take a step back and point out, I do not for a second believe that Secretary Xi or the Communist Party are ultimately staying up at night because the stock market isn't doing well. I don't think a lot of their attention goes towards the stock market. I think the vast majority of their attention really, quite frankly, now goes towards national security issues. But that said, you can't ignore the stock market altogether. So stabilizing the sentiment over there and helping the market recover a little was certainly important.
This stimulus effort, what do you think about it? Is it good or bad long term, short term? What's your overall view of it? Well, stimulus in general.
Look, there has to be some amounts of stimulus taking place within the economy, but it needs to be very, very targeted. It needs to be, I think, much smaller in scope and scale than investors want it to be. So why do I say this? Again, let's look at the economic realities of China. Those years of high single-digit growth are way, way, way back in the past, never coming back. What you've got ahead is an economy that can no longer function on the old premise of we're going to invest a bunch of money, we're going to build a bunch of infrastructure, and it's going to result in high levels of growth. The road has completely run out on that thing. The future now is something that is much slower pace, and in an ideal world, more sustainable because it is driven by strong household spending and strong consumption parts of the economy, not the high investment or the traditional industrial parts of the economy. So now we have to focus on what is it going to take to help transition the economy. That's where you get into the stimulus side. So could monetary policy be helpful? Yes, it can, but not the way they're doing it today. Monetary policy can be helpful if you actually create specific types of loans or lending facilities that are targeted exclusively towards private enterprises, towards SMEs. These are parts of the economy that the Chinese policymakers have been telling us that they're trying to help for years and years and years, but in practice, in reality, it just doesn't happen. Our proprietary tracking, for example, of credit access. One of the things that we see repeatedly is that SMEs borrow at far higher costs, at a far higher cost than large firms do. And their borrowing levels typically tend to be far lower as a result of that than compared to large enterprises. Money is simply not going towards the parts of the economy that would actually be driving China forward from the standpoint of hiring a lot of young folks, right? Youth unemployment is a big problem, right? So, and be putting money back in the pockets of Chinese households that can go out there and spend and help lift overall consumer sentiment and consumer spending. So those sorts of that's an area where you could have stimulus, as I've laid out, but we're not really seeing anything of that sort. The property market overall, they really strangle they tighten the noose around the neck of the property market pretty severely. Letting some of that go now makes sense. Has to be very slow and very measured. You cannot get into the problem of, again, reflating the bubble. So there is good stimulus that can be done in China. It just, we're going to have to wait and see how much of it is actually coming through.
So when like JD over here is old and grey in the many decades to come, as you said, they've gone from this huge growth now to like it's more of a slower burn. Like, will China eventually get to the point, look, of a Japan where the economy will start deflating, and if so, in the future, what like effect is that going to have on the rest of the world?
Yeah. So look, I mean, if you get a Chinese economy that can manage to grow more than 1%, 2% at best, and then you get some years where it's just seeing no growth at all, or you're getting these patches of stagnation, that is naturally bad news for at least parts of the world, right? That's bad news for commodities producers predominantly, for selling China copper and steel and oil and so forth. That's pretty bad news for you. On the other hand, it can also be bad news for you if you're trading partners of China, and we're in a position similar to today's, where the government realizes, okay, property is a very small part of the overall economy. We want it to be that way. And that's where it is. We haven't been very successful at getting Chinese consumers revved up. So consumer spending really isn't driving much of economic growth. Well, it looks like we're kind of stuck with having manufacturing just be that economic driver. And yes, it's not the manufacturing of to the 2000s or the 2010s, but it's still something. So, what you do is you continue pumping money into that sector. And to the extent you possibly can, you continue flooding the world with cheap products. You bring prices down artificially. You keep subsidies high. Well, that's really bad news for the economy for the other side, right? Because then you're talking about that continuation of the overcapacity problem in China, which is a big policy concern and a legitimate problem that we're facing now. I mean, what has China done since the outset of COVID? I mean, it's been a manufacturing-driven recovery there. And over the last couple of years, especially, countries around the world have realized, man, there's a lot of Chinese steel coming into our borders. There's a lot of Chinese copper coming now into our borders. There are a lot of cheap Chinese cars that have absolutely decimated the car industry and the automotive industry around the world in different countries. Europe, of course, overwhelmed with Chinese EVs. So you could have that. So in any event, a China that is not a vibrant economy, even though it is growing at a slower pace, a China that is not economically successful is bad news for multiple reasons.
Do you think that's going to really drive the ex-China theme around the world, if that is the case? Like debottlenecking everyone from China?
So when you say that, do you mean getting China out of supply chains? Or do you mean getting China out of stock indices? What specifically are you thinking?
Yeah, supply chain, mostly.
Yeah. I think there's absolutely a policy push now within the United States. We're getting some of this in Europe now. The whole concept of China plus one, China plus whatever. And that's most likely the trajectory of where things are headed. But there's no telling how quickly that's going to be accomplished and how deep it's going to be and how wide it's going to be. So how many industries ultimately are going to be forced to say we need China plus one? A lot of industries a lot of manufacturing, broadly speaking, of course, realized that during COVID when their factories kept getting shut down over and over again, and they couldn't produce things to service their clients back in their home markets, or even if they were foreign companies, Vietnamese or so forth, that were selling abroad, right? Or selling elsewhere in Asia. Okay, so that was a lesson you took away. But COVID was potentially a once in a lifetime thing. Maybe it doesn't come back. So that risk comes down in your calculations. Well, certain critical industries, maybe the medical industries, the pharmaceutical industries, and so forth, maybe they realize that you do need to have a China plus one. But where do you go? Where's the capacity elsewhere in Asia that can actually be a legitimate transplant or alternative, I should say, to producing in China. So I think we're seeing this unfold. I do think that ultimately policymakers, especially out in the West, are going to start applying more and more pressure. It's just going to take a while to build up. The political, I think desire is the political will is there. I say it cautiously, but I think politicians need crises to do the right thing sometimes, and it's taking them a while to get their act together, I think.
Shehzad, you mentioned the property sector earlier there, and I think the number that's commonly thrown around that it makes up sort of 25% of the economy, and China very much has the interest to pull that into kind of size. What do you think the end game is? What do you think the natural size for the property sector as a part of the broader economy is?
Yeah, that's a question. Well, look, it's all TBD, and we really will not be able to figure this out for, I think, several years ahead. And I'll tell you why this is so complicated. We're in a period right now where the property market has been basically in a free fall. The housing market is at the lowest levels that we've seen it at, and the commercial real estate side of the property market is also, by the way, in a lot more pain than is understood or acknowledged. You could get a property market bailout, as we're seeing happen right now, that stabilizes the property market, I think, or helps the market find a bottom in the bigger cities. But I think this is sort of a cyclical thing. Maybe you get a couple of good years, and then again you start getting some amounts of property pain cyclically in the bigger cities. Those are the bigger cities. That's what everybody focuses on. And I think if you get a cyclical bottom in places like Shanghai or Beijing and all that, most of your market participants and Western observers and bankers and our investment bankers, I should say, and analysts, they'll be pretty happy. But there's a whole bunch of pain in the property market that is going to go, I think, unacknowledged and unsolved or unresolved in the lower tier cities, where, by the way, the bulk of the overbuilding took place. So if you think about including that in the accounting of national statistics, well, that's going to be a big problem year after year after year, where those apartments are just sitting empty and nobody wants to buy them, and people who did own them are not able to get rid of them. And so that's just a dead weight that you're carrying. So I think it's not clear whether this ends up being 5% of the GDP, whether it ends up being a little bit more, ends up being a little bit less. But we know it's going to be a sliver, and we know that it's going to be a pain point for a while to come, even if in the short run we start to get some amounts of this idea that, okay, finally there's a bottom, things are stabilizing, maybe there's a chance that prices start to go up a little bit. People start coming in off the sidelines and buying up apartments and stuff again.
Well, people are coming off the sidelines, boys, for K-Drill. That's who's coming off the sidelines. They are staking their claim as we speak in WA exploration.
Good to see more companies using the names K-Drill in the announcements.
There is, and we've got one right here. Bloody, look at smashing out some RC holes at the Goldworthy East project for macro metals, like just highlighted there. K-Drill, mate, free advertisement for ASX companies. You engage K-Drill to do the contract for you, you get a screenshot. That is like bloody the deal of a lifetime. And I've got a bit of word on the decline.
I think they knew it because they put in 2 photos with K-Drill in the captions as well.
Bloody easy.
And they get to meet Ryan O'Sullivan.
Mate, and a bit of word on the decline about Ryan O'Sullivan, as we know, like, because it's old news that he patented the bare hand drilling technique. But mate, I'm hearing he's actually training up Drew Harvey on the technique so they can cover both day and night shift.
What's the technique?
I don't know. It's
turbine?
patented. I'm not willing to go there due to legal battles.
I don't know how they're going to do that, and the BD at the pubs. If any team can, it's the K-Drill
If
team.
you want a bare hand drilling demo from the great Ryan O'Sullivan and his protege Drew Harvey, give K-Drill a buzz, and holy snap and duck shit, they can punch in some RC and diamond holes for you as well.
Go K-Drill.
Go K-Drill. Go Australia.
So do you think we then see a couple of these property developers? I mean, we've seen some big names in recent years, but do we continue to see them go to the wall in the next 5-10 years?
I think there's more pain ahead, and some of the smaller developers, we might start hearing of developers that are second or third tier also that are in trouble. The size of the overall balance sheets are naturally not going to be what the big ones were, what like the Evergrande of the world were like. But I think the idea that somehow developers are now going to slowly be able to get out of trouble, I don't think so. I think there are going to be lots of developers, including the big ones, still sitting, with a lot of debt that they are unable to repay in any time soon. So I think there's still bad news ahead. If you're a bondholder of a Shimao or a Country Garden or whatever else, or some other Chinese developers, I think there's probably still some more pain to be felt down the road.
And on the commodities you mentioned earlier, you mentioned copper, steel, iron ore. I found it pretty surprising. We were speaking about this a couple of weeks ago to see them all rip a bit higher on the back of all the stimulus, given the by and large sort of monetary nature of a lot of the stimulus. Not too much big infrastructure plans or anything like that. So I want to hear it from an expert. Did it surprise you to see iron ore jump as high as it did, and steel and copper and other sort of base and industry metals?
This was all speculation. I mean, we certainly got a big, rally in the equity side. A lot of it was, I would say, significant amount of speculation there. But I think the commodity stuff is largely speculation because let's think about this. Has there been any announcement on the fiscal stimulus side to date that says we're going to do more building, port renovations of other infrastructure, perhaps construction of new infrastructure or upgrading of new infrastructure, that would help us say, okay, there's going to be more steel that's going to go in or more copper is going to get used. Okay, that's a bullish side. I haven't heard anything. Property market. Let's look at the property market. You know what they're saying? They're trying to do two things, right? They're trying to, first of all, apartments that have been paid for but not yet built, they want to get them finished and so that people have access to them. Is that somewhat bullish for commodities? Maybe, but unfinished apartments can be at different phases of the finishing cycle, right? It doesn't necessarily mean they're completely unbuilt. But the other thing that they've announced is no new construction, or at least they said they're going to like to see no new construction because they don't want to have more property coming online when there's a whole bunch of existing property that they're having that companies are having a difficult time offloading and selling, and there's already that inventory of unsold property that has been building higher. That part of the policy plan, by the way, is awful for commodities because that means that construction activity, which has already been quite low by historic standards, can only get further depressed if they actually push the go button on that. So that's net actually pretty bad, I think, for commodities. So this is, so that right there tells you that a lot of it is speculative fervor. And then number three, the big picture thing we keep coming back to, what part of the stimulus plans announced so far are actually stimulus measures that are going to impact the real economy? Very, very few, if at all, as we've laid out. So unless the impact on the real economy is clear, there shouldn't really be a reason based on fundamentals for commodities to be rallying. So I think a lot of it we can probably summarize and say it's positive vibes.
Well, why didn't the stimulus focus on the real economy? Is it just sentiment and seeing housing prices, in seeing, your shares that you have in your portfolio go up to kick up the sentiment? Is that why they targeted it in the way they did?
I think the biggest way to target the real economy is through a combination of packages that are multi-phase, so multi-year packages that get at the short-term sort of maybe, you could right now call cyclical problems such as a soft consumer spending, but really as part of a larger structural problem. But really, that get it correcting some of the structural problems within the economy. So short-term boost when it comes to affecting the real economy would be giving households money to spend, giving them, whether it's cash vouchers, whether it's other forms of stimulus checks. It doesn't have to look like what happened out in Europe and the United States in the aftermath of COVID. It's not the same kind of economy. It's not the same kind of advanced consumer economy. It could have absolutely be done with Chinese characteristics, if you will, but some amounts of money that is going into the pockets of Chinese households that encourages them to go out there and spend. But we didn't really see that. What we got were trade-in programs. Okay, trade-in programs are great, but trade-in programs have a much lower ceiling. So you could exchange your refrigerator out for perhaps a newer one or a slightly less old one, and you can do those sorts of things. You're pulling growth forward, and that's fine. But that means that's growth you're not going to get 6 months out, or even potentially even next quarter. And it's not it's not a sustained thing. How many times can you swap out a old computer or so forth? So the stimulus measures still have to be, when it comes to the household side, they have to be a little bit bigger. They have to be a little bit more sustained in nature. That would be the most direct way to immediately boost the Chinese, to boost the economy over the next several quarters, going through at least through next year. But they haven't done it. If you talk about the bigger structural things, I've already talked about doing monetary policy stimulus focused on the SMEs and the economy, the new economy industries and the private market. Start addressing other structural factors like what is going on with elder care in that country, right? It's a graying population. It's an older population, that demographic decline that we talk about. Announcing very serious amounts of social spending as in regards to Social Security, healthcare spending, and everything else that you would need in terms of having a social infrastructure and a policy infrastructure to support your elderly population, and therefore also take pressure off young people who are oftentimes making a salary and having to support parents and grandparents. Number three, and I'll pause there. You want people to have kids, right? 2 kids or 3 kids now. Well, provide the type of childcare support that they would need to do that. So this is where I'm talking about a much more involved in a bigger welfare state, if you will, and social services spending that the Chinese state today has in plan. That's stimulus, but that's really going out and trying to get into the structural side of the economy. I even touched other things like the more privatization and the transfer of state assets into private hands, and all those other kinds of things that could be done, which would be stimulative in nature, but really are more structural changes to the economy than just announcing a stock market stabilization fund.
My peak stimulation occurs when I see some Greenlands equipment people on site sorting mining companies out for any water-related stuff. Oh, look at this. Look what I've found.
What am I
This
looking at?
Greenlands expert checking shit with a notepad. You know what a notepad means, boys? Attention to detail. Have a look at that, mate. Look at this pond and pump setup. Right, I look at it and I think, holy shit, that looks complex. But no fear, money miners. That's why Greenlands run the water game.
Gotcha.
Like complex water projects for them are like me making school lunches for the kids. Fucking easy. Like just piece of piss. Do it every morning. So, mate.
It's like a Lego project.
Yeah, but no, Lego heaps harder.
Oh,
Like, yeah.
yeah,
You wait till you have kids. You still bloody. I'll do the kid jokes. Oh, mate, you want any water job done on site? Greenlands needs to be on your site.
The go-to name.
Go, give Caleb a buzz.
Go Greenland. I want to go deeper on the commodity and the industrial part of the economy, Shehzad. One of the big trends we'd seen over the past 10, 15 years was the One Belt, One Road initiative, China going overseas. One of the areas that we saw quite acutely was in Africa, China just gobbling up assets and also just helping build ports and these sorts of things. Do you think that's something that slows in the next decade?
It seems like a lot of the One Belt, One Road activity slowed down in the middle of COVID for sure. And since then, I think has been pretty slow. And there are a couple of reasons for that. The COVID zero policies were obviously a big chunk of the driving force. The need to focus domestically has been important. The trade war that then started, of course, before COVID with the US probably had already been putting pressure in. I think a lot of the focus is on national security as it relates to strengthening the domestic economy, as it focuses on decoupling from the West, as it focuses on indigenization of technology. And I think that's increasingly taking on a lot of the policy focus of the party. I think a lot of the financing is also being redirected maybe in part, or a lot of the financial firepower now. You're thinking about how to use your finances for those purposes and not just to get into these projects abroad. But then the other side is that, China has been doing One Belt, One Road did it for over a decade, and kind of started to realize that it's, whereas the big grand strategy parts of the argument make a lot of sense and it sounds super sexy, and people in DC certainly were very alarmed by it. This stuff is hard to pull off. these are very difficult countries to operate in. These are very complicated markets to operate in. And, not only do you get into these areas, are these problems where the loans that you're giving out may never get repaid, but, you're also putting your people at risk. There's physical security also. And that, you could take the physical security and perhaps you say, yes, you're going to lose some people to a terrorist attack or to an uprising because the locals don't like it, to an armed uprising, to locals and maybe in an area don't like it. On top of that, you have to deal with incredibly corrupt countries that are just have incredibly corrupt, large amounts of corruption, just to put it frankly, have an incredible amounts of red tape, both because of bureaucracies and because of the way that the countries are structured politically. And all in all, it ends up being maybe the bang for your buck isn't so high, or maybe you have to. Maybe people in Beijing have wondered if so to speak the juice is worth the squeeze. So there are, I think, multiple factors that have contributed towards the pullback in the One Belt, One Road initiative.
And on the sort of topic of China's foreign relations, foreign policy, how do you see that also playing out? One of the big themes coming out of COVID was this decoupling, friendshoring or reshoring, whatever you like to call it. Is that a trend that you believe will just continue on? And maybe it's a bit out of your area of expertise, but that seems just very inflationary for the rest of the world. Is that something that's going to stay true throughout the 2020s?
So, I think it has to be acknowledged that a big chunk of the reason inflation was so low before COVID was because of China, right? Because China was able to you could produce things in China at very, very low levels. A lot of the low levels of global inflation, at least in the Western and developed world that you got, were thanks to China, at least in the United States. But then what we also learned is that some things can be too good to be true. And when COVID hit and China shut down, and China, from a political standpoint, became a very difficult country to deal with because of the lack of transparency around what was happening with COVID and dealing with COVID and COVID policy, and their desire to reject Western vaccines then and say, we're only going to rely on domestic vaccines. And then those didn't really work. And then you got repeated shutdowns, and it created a lot of uncertainty and upheaval out West. What we learned is our supply chains are very, very insecure. And the insecurity of supply chains then contributed towards historic levels of inflation, certainly out in the United States and also elsewhere. So that has led to this idea that, okay, you cannot have all your eggs in the China basket, that you must diversify supply chains. It's been the added factor, of course, is that it doesn't have to be a pandemic or an epidemic, a health crisis. That's the only problem. You could have geopolitical risk be another problem. And so it's not safe to be wholly dependent if you're a foreign producer, a foreign company, or even if you are a foreign company that just buys from a domestic Chinese producer, to be entirely dependent on China. So it's these factors that have led to policy pressure building up, but also companies themselves, I think, realizing that they need to diversify their supply chains. And that could absolutely carry the risk of being inflationary. I think it'll certainly be more, there will be higher inflation. We are in a higher inflation environment, likely remain in a higher inflation environment than we were pre-COVID, at least in the foreseeable future. But there is sort of the necessity now to avoid the downside risks of what it is to partner with China that you have playing out. On the other side, I think the decoupling, I think it's going to be selective decoupling. I think it's going to be particular industries. It's not decoupling across the board, but especially when industries that are seen as very, very important, whether it's critical minerals, whether it's certain technological outputs, whether it's certain, of course, we talked about the medical industry. I think you certainly get decoupling going on over there. There's also other parts of decoupling, by the way, which is decoupling in the financial space, there's decoupling in the technological space, which are national security priorities and prerogatives of policymakers out west. Slowing down transfer of technology to China as it relates to selling them chips or advanced or things that would go into making them an advanced manufacturing, a powerhouse in advanced manufacturing. And financial decoupling, similarly, putting money into Chinese companies that tomorrow could develop the technology that could be used by China or the Chinese military to increasingly become more and more dominant as a military a player, or military eventually become a military superpower in the world, that one that rivals the United States and its Western allies. So you've got all of that playing out simultaneously. That's all true. And let me stop at the last point. There's what I like to constantly remind folks of: China decoupling from the West, which I talked about earlier. So there's decoupling happening across the board. It's happening in various shapes and forms, and it's not just a Western-led thing. It's actually, you've got the Chinese policymakers and Xi Jinping himself saying we need to lessen our reliance on the West, especially in the domain of various technological goods and inputs that they rely on.
Is anywhere in the world ever going to be as cheap as China in the future? Is there ever going to be an alternative?
Probably not, because it's probably going to be very hard to find another country in the foreseeable future that is both has as large a
communist
labor
country
market and a place where you could just have rates as low as possible, which, by the way, is a kind of a problem, right? It's as we think about labor rights around the world, and as we think about things that are standard of working and so forth, it's not the greatest thing, right? So it comes that someone pays the cost for those very, very cheap goods that we've been able to benefit off of. And I think that's becoming harder and harder to see. I think places like India, which could again be a little bit competitive, I don't think you could have labor there ultimately be as cheap. And there are all sorts of other problems in these other places: lack of training, lack of infrastructure, and so forth.
Well, one of the products that has sort of hit us in the face with how noticeably cheaper it is China made than elsewhere is electric vehicles. And we can see it in Perth now. BYD, they're popping up shops on numerous corners where it used to be a Western car maker.
And they're not. It's not like they're shitter. Like people like BYDs better than Teslas, and they're heaps cheaper. Like it's not. Yeah, like you're not sacrificing quality either.
The quality reviews from everyone I've heard is top notch. They are in no way inferior to maybe in brand status, but in no actual tangible way are they cheaper in quality to a Western car. Now, on the topic of countries being friendly with one another, we've seen enormous tariffs on EVs, and Australia smartly hasn't whacked them on because we're so reliant on China. But how long can that really last? Obviously, a lot of these countries that whack on the tariffs are protecting industries of their own. That seems, in my kind of view, to have a finite date in which their OEMs have to get to a standard where they're just producing a better vehicle. But what's your view on that, Shehzad?
Yeah, look, I think so. Chinese EVs, right? It's a classic story of how China is able to dominate global, industries across the world. And so, what do? They provide so many subsidies for so long that it becomes incredibly dirt cheap to produce this product. In this case, EVs. It allows for a lot of companies to prop up to do the same thing. They steal a little bit of technology from Tesla, and then they continue to they work on that and improve on that and so forth. Two things have happened as a result of what you just described. They've flooded the world with their cheap cars, which, as you correctly said, are not necessarily worse quality. And they happen to be a fraction of the price, US dollars. You can sell a car for $10,000. That is very cheap.
Phenomenal. Brand new.
I mean, you're right. It's insane. And it's also, of course, created the alternative problem where domestically now you've got Chinese EV makers who are just struggling because there's so much competition and everything is so cheap that the bottom line is hurting for them. So what do you do about that if you're United States or if you're Europe? Because no matter how many subsidies you levy on, so the $10,000 car with 100% subsidies becomes a $20,000 car, and with 200% subsidies, so on and so forth. But your own producers still cannot compete. So you're stuck in a difficult place, because if you want your consumers to have access to a cheap product that is good, and you want it to be produced by and large by a local producer, whether maybe they still do it in a different jurisdiction, you still have to throw a lot of money at them. You have to heavily subsidize them if you're a Western market to do that. So that's the struggle now that I think, at least from an American standpoint, American policymakers are going to be facing. The Biden administration put on those tariffs, but they're not in themselves going to be good enough. The Chinese say, okay, forget about it. Let's get into Mexico and just produce the cars in Mexico. And sure, they'll be a little bit more expensive, but they'll still be considerably cheaper than what any other American car manufacturer can do. So now you get into this other tussle of how do you define what's a Chinese car versus a Mexican car. All that's to say, it is very, very difficult and very, very complicated, to do so. Of course, keep in mind, we don't have Chinese EVs in the United States today. So once you let them in, it might be hard to, force them out. But if you don't let them in, your consumers are worse off. But your domestic car manufacturing industry is happy, and that part of the electorate and the labor market, of course, and those workers and those unions are certainly going to be very happy. So it's this political tightrope of in many ways that you have to walk.
China put forward the goal of net zero by 2060, I believe, and EVs is one component, but it also ties in very strongly with what you said earlier, with a national security and a China sort of independence kind of focus. What do you make of that goal and their journey to get there? We've also seen them go pretty hard at nuclear and other sort of sources to really wean down their reliance on all other countries. Have you got a sort of differentiated view on their journey to get there?
Look, I don't have a view on this one, but I will say that one of the things that we are certainly seeing over the last few years is that reliance on coal is pretty high, and there is a lot of coal being produced in China. And when it's cheaper for them to import it, they certainly are importing it in pretty high quantities. So if you are trading coal, if you are interested in understanding where that trend has been in terms of coal production as it feeds into not only just steel, because China's also producing a ton of steel, so much steel that they're just, as I said earlier, just pushing it abroad, exporting it abroad. And that's been a driver of growth for them, their export growth, but also just for domestic energy purposes. So I'm not an energy specialist. I don't have a call or a view on their net zero emission targets for the future. But I think we have to keep in mind that certainly their reliance on the fossil fuels, certainly their reliance on coal remains pretty serious and pretty severe.
On the matter of steel, that's another one where we'd seen tariffs kick up. Just I think last week I'd seen the Canadians ratchet up defense because China, I think in their words, is just drowning the world in steel. What does that kind of lead to?
Yeah, that's been one of the things we've been tracking for the last, over the last year. We've seen, especially over 2023, we saw a lot more steel production than was expected coming out of China. Beginning of that last year, the idea was Chinese steel production was actually going to continue to decline for a third year, and that didn't happen. So ultimately, we found that a lot of that steel was making its way over abroad. Most recently, we're again actually we have seen the seasonal kick up in Chinese steel production over August, over September, even though it was muted earlier in the year. Sort of, you had sort of this decline taking place in Chinese steel production. Now we'll see if it continues through the rest of the year. But the bottom line is that in an overall economic environment where there is a slowdown, there has been this doubling down on the industrial side of the economy, and specifically on the commodity side of the economy, where you may be losing money and you may not be making a ton of money along the way, and you may be having to cut down prices, but the plants are pumping it out. The regional and provincial political authorities are not forcing the steel plants to cut back on production. And ultimately, whether it's through a combination of subsidies or other means, people are being kept employed, which is important, and the excess product, because there's nowhere near the demand domestically than the output that you're getting is finding its way in foreign markets, and you're finally getting the political sort of response for it, as is predictable. The real question, of course, is where do we get in this cat and mouse game, right? Are subsidies, are tariffs going to eventually be high enough to cause enough pain to where you see China change tack, or ultimately it is fundamentally so cheap for them to do this that their ability to withstand the pain is way, way, way higher than perhaps even the political will in these countries for raising tariffs. So that's the battle that's about to play out, especially as we look to 2025 onwards, and we get towards this renewed trade war. Especially, I think you get this round 2 of a U.S.-China trade war going into effect, and we begin to find out how much pain can the Chinese side withstand, and just how, in what areas, and how much, and how many tariffs, and how quickly can an American president really start levying tariffs on, whether it's a Trump administration or a Harris administration.
Is it too simplistic to think that the reason there's so much more steel exports in the past few months and year or so is because they don't want to consume it or need to consume it in country?
Yeah, that's a big chunk of it, right? So they're producing a lot, regardless of what's going on domestically, because it's one of the areas it is one of the areas they have doubled down on. Industrial, the industrial sector writ large, manufacturing, absolutely, of goods like whether it be apparel or cars or whatever you may, but commodities manufacturing has been a big part of the story, especially over 2023 and now into 2024. But yes, it's absolutely true that they have no reason to consume as much of it because of what's happened in the property market. The downturn in the property market and the very, very low levels of construction activity and absolutely low levels of infrastructure development in China have meant that the domestic need and the domestic demand for these industrial metals is far lower than what it used to be. And so you're left with a lot of excess product that you are then dumping abroad.
Shehzad, if we look forward, say, to 2050, how do you think China compares in terms of power in the world, in terms of its economy size, in terms of GDP per capita, with the US and other countries that you might think are running pretty quickly?
So, I think in the aftermath of COVID and the slowdown in the Chinese economy, and then the acknowledgement from the Communist Party that, look, we're looking at a future of slower growth and we're going to make it more sustainable and so forth. It's become really fashionable, both on the street and in the policymaking world, to sort of have these doomsday predictions about China. That the Chinese economy ultimately will, get stuck in a period of stagnation. That they're gonna, or that parts of the Chinese economy are just going to simply fall apart, or that there's going to be this big Lehman moment that's going to take place, and the financial system is just going to absolutely crash, and that's going to be the doom scenario. And the policymaking side of the world, especially out in DC, has a similar viewpoint. That whereas today, we're concerned about China as a competitor of ours or as a global rival, that I think they're just going to internally implode because of all the various economic problems that they have, and then it's a house of cards is going to collapse and so forth. I don't buy that at all. What I think is you get is an economy that remains, at the very least, the world's second largest economy. That, yes, grows at a very slow pace. Do I believe today that they magically pull off that great economic transition that they foresee? Which I compare to sort of turning around a huge ship. I used to call it turning around the Titanic, and then somebody interviewing me said, "Shehzad, the Titanic sank." So I said, "You're right. I should have called that because
people still go and say it, but."
But it's still akin to turning around a very, very large vessel. And I don't think the success is at all guaranteed. I don't think they're doing things today that even give me confidence that they're going to necessarily succeed. But I don't buy this idea that China implodes and becomes sort of this very economy. I think you could get a combination of things. You could get an economy that grows at a very low level, maybe even goes through some periods where it doesn't grow at all. But then at the same time, they have been able to make the right decisions in the area of technological growth, that they do have an important, if not a dominant position in high-end manufacturing of technological goods, that they, I think, end up getting some amounts of indigenization of advanced technology and so forth. I think they'll likely accomplish some of those goals and become this big, important military powerhouse around the world. They're still very large. Being number two is very impressive. If they remain that, God, even being number three is very impressive in this world. So I think we have to think about China from that standpoint, both from an investing position as well. By the way, the overall slowdown may not mean much. I think opportunities in China increasingly lie below the surface, and it's time to get very, very serious and sophisticated about the Chinese economy. Because if you're just looking at the overall GDP number and investing based on that, as everybody who invested in China more or less did, you're not going to make any money anymore. You have to get very real about where's the money flowing internally in China. What are the opportunity industries that that are being created because the Communist Party backs those industries, and those are the favored areas of growth, and likely areas where the opportunities lie, and where there's a ability to make money. And I think same from if you're thinking about assessing the geopolitical risk and assessing China's geopolitical entity, I think start focusing not just on this overall picture, but really what they're getting right, and then where the risk factors are, and where they might fall behind or may just fail outright and not succeed.
You made the comment earlier of China wanting to become less reliant on the West, and tying this in with its recent military dominance, and it's also been a powerhouse for 2,000 odd years, or maybe even longer, just very kind of inward focused. Do you think over the coming decades they look more and more inward, and perhaps reflecting on the China of the 1900s, they really try and wean themselves off all sorts of reliance of the outer kind of world?
Well, what they want to wean off is their reliance on Western countries for things like, so they don't want to rely on NVIDIA for chips, or they don't want to rely on ASML for lithography technology and machinery. Right? They want to figure out a way to produce the advanced chips themselves. They want to figure out a way to produce the machinery to produce the chips, and then take it to other areas, when we think of advanced technology. They've already done it for, obviously, and in the EV, they've shown their dominance in the EV world. They've shown how they can do. They've taken over the global solar panel market, obviously, right? So they've shown us how they can do more. That China is not just there to produce your T-shirts and your sneakers. They can be doing things that are far, far, far more advanced and important to national security and military superiority and so forth. So I think they continue to pull back in those areas. But I don't think they pull back in other areas. I think you get a China that continues to focus on building alliances abroad and building and friendships abroad. Do you get a China that tries to mimic typically what the United States has done since World War II and thereafter, where we are sort of the policemen of the world and involved in conflicts everywhere and so forth? No, I don't think so. I think that you probably get more continuity than not. I don't think there's any urgency when it comes to Chinese policymakers to get involved in hostile conflicts they're actually wars, whether they are skirmishes or insurgencies or hot wars or so forth. Yes, they want to place the world. If they can bring people together around a table and get them to hash out a friendship agreement, or maybe restart a dialogue the way they did with the Iranians and the Saudis and so forth. Yeah, they want to be on the table as somebody that can negotiate deals and that can create stability. But they're doing it at a very low level because the risk of failure is very high, and they're not putting their stamp on it and even putting their reputation behind it either. So they're going for the low-hanging fruit in many ways. So I think they stay involved globally in these in this manner, in these ways. I don't see them turning inward at all. They can't afford to. As a matter of fact, a big chunk of their focus is outward. It's projecting their power in the South China Sea. It's projecting their power and keeping open that option of retaking Taiwan. It is about showing the Philippines that they're the bigger power and they're a boss, and sending that message across to other nations in Asia, which may not be particularly friendly towards Chinese interests any longer.
Shehzad, I think I've exhausted all my questions.
Oh yeah, I didn't have any at the start, so bloody JD was the man behind this, mate. So no, we can't thank you enough for taking the time to educate us Australians on everything China, mate. That was absolutely sensational.
That was fantastic,
Well,
Shehzad.
I
Thanks
like
for
to
your
just
time.
find experts. Then I don't have to read anything.
Well, thank you so much for having me. This was great. Great conversation.
Good stuff, JD. Bloody, mate, in the weeds, China.
We're learning more every day, mate.
Jeez, I've definitely got to listen back to that. I did try and ask a nuclear question, but that wasn't in the wheelhouse. I'm like, well, just go get a coffee or something.
Not following Rolodex, nuclear question.
Yeah. How can I bring this conversation back to something I know? Yes, no, good on you, Cobber. Appreciate that, mate. JD, who else is are you going to give a good on you to?
Well, top of my list would be MMS, Matty.
Top of the list every time.
And it's a sort of equal top also with Grounded, CrossBoundary Energy. The list goes on, actually.
Oh, Sandvik Ground Support.
They're right up there, mate. CRE Insurance.
Yeah.
Greenland's Equipment, also equal first. Cadrill, MMTS.
Oh, mate, and Reece Matolny at Australian Earthworks and Haulage. Oh,
And last but not least, Spark, mate.
Use it. Righto, Hoodaroo, money miners.
Hoodaroo.
The information contained in this episode of Money of Mine is of general nature only and does not take into account the objectives, financial situation or needs of any particular person. Before making any investment decision, you should consult with your financial advisor and consider how appropriate the advice is to your objectives, financial situation and needs.